I'm going to dive in just with a very brief overview of how Antipodes goes about investing before diving into how we're seeing the world and positioning the portfolio. So look, when you look at this slide, it's the classic funnel slide. Antipodes really filters the universe using a combination of our qualitative experience and quantitative filters and screens. We complement that with really deep industry level research, which allows us to cover what is a very broad universe in global equities. It's 3,500 securities roughly in ACWI. You can't be an expert in all those companies, but you can be an expert in all those industries. And then that will lead us to the winners and losers at the industry level. And when the market starts to price them inefficiently, we're really ready to act. And we go about building the portfolios. Each of the sector teams, there's only 5. So we don't carve the universe up into too many silos. And those 5 sector teams are really building portfolios, paper portfolios, which we use as the building blocks to all of our strategies. So across our firm today, Antipodes Group is managing a roughly 18 billion, and half of that is in global equities. Across global equities, and in my role, I'm CIO of the 9 billion that is in global equities. The strategies are long value, global long short, and then we have a small mid-cap strategy, and then a series of EM and Asian strategies. So just to recap on our philosophy, as Mark mentioned, pragmatic value is really paying the right multiple relative to the growth rate, and whether it's cyclical or structural, and the underlying business resilience. So for example, we have classic mature cyclical like Total Energies that trades on half of the multiple of Exxon for a higher quality energy company because it's listed in Europe. In the middle of the portfolio, we have Sanofi, a pharmaceutical company, which trades on a PE of roughly 11 times that has very little American drug pricing, regulatory or price risk, or has exposure to loss of exclusivity. So it can compound earnings in the long term in the high single digits on a very modest multiple and very defensive in its growth profile. And then in the higher growth, high quality component, Alphabet, where investors are concerned around the range of outcomes. Whether AI is good or bad for Alphabet is being deeply debated. But I think that's the opportunity to buy a very resilient, higher growth business on a multiple that doesn't recognize that structural tailwind that they have across all of their businesses. Value as a factor has lagged, but pragmatic value has beaten conventional value, and it's broadly kept up with the market in our global value strategy. In recent times, we've lagged as the quality bubble has grown. Now, we call it a bubble because the factor, if you measure it just quantitatively, and you take the top quintile of profitable companies, measured over a 10-year period, and then you say, okay, what do you have to pay to get exposure to those amazing companies? That multiple is close to an all-time high in both an absolute and relative sense, and it's much higher than the last bubble in 2000. Value, on the other hand, has rarely been cheaper. And let's be clear, value doesn't mean rubbish. In that cohort of 10 stock, of that cohort that's trading on 10 times, yes, these companies have grown more slowly, but you have to question whether the 2.5 times PE multiple is justified relative to that slower growth. The other observation is, as the market's crowded into US tech quality, the concentration in the benchmark has gone up. Arguably, the benchmark is becoming more risky from a value at risk perspective. Concentration we would equate with risk. All funds that are essentially measuring or managing to the benchmark have this risk in their portfolio. In the S&P, as you know, 10 stocks account for 30%, but it is a global phenomenon. What we capture here is the outperformance or underperformance, if you like, of an equal weighted expression of the ACWI, the world index. So what changes the concentrated nature of the market and US exceptionalism, tech exceptionalism? What can broaden out the number of winners in the market? We think it can broaden in three ways. Firstly, geographically. Fiscal impulse is shifting around the world. It has been led by the US, but others are responding. Secondly, it can happen at the sector level. The global manufacturing sector has been in a 3-year recession and is starting to inflect upwards. It can catch up to where the service economy currently is. Thirdly, markets can broaden in a style and thematic manner as investors start to contemplate not just the AI enablers, but the companies that can deploy AI. And look, as we know, when the range of outcomes around a new technology start to widen, the market applies a much higher discount rate to those companies. Let's touch on the regional opportunity. Fiscal impulse. The US is exceptional in a number of ways. It has been a leader in technology. We all know that. But it's also been exceptional in the way that the government has spent money. If you measure cumulative fiscal deficits from the first Trump presidency to today, the US has stimulated roughly twice as much as Europe. So some of that exceptionalism is cyclical, we would argue, not structural. We're moving into an environment where we think other regions are starting to look at the US and potentially, are slowly learning from the playbook. And Germany, it will be very interesting post the election as to whether they start to loosen and really lead Europe into that looser policy. And certainly China is displaying more willingness to stimulate after a very long period of resizing their property sector. Let's touch on the opportunity at the sector level. What you see on the left-hand side there is that the yellow line, which is the services PMI, has significantly outperformed the manufacturing PMI, in an almost unprecedented way. And that is because US households and global households, especially wealthy households, who are benefiting from very high asset prices, consume more services than, let's call it, lower income households. And we also had to normalize for the overconsumption of goods during COVID. Reopening was led by services over goods. Now we think there's a mean reversion opportunity in manufacturing, even with noise around tariffs. The right-hand side shows you that the high-frequency data, which is the teal line, is already inflecting upwards in manufacturing. Okay, style and thematic broadening. In our view, any new technology, this AI cycle is going to be with us for a while. The question is, as this technology is adopted within corporates, we think the market will move from those pick and shovel companies, the Nvidias and Broadcoms, which have been very strong stocks in the last 12 months, to the companies that are going to benefit from this technology, deploying it in their businesses. And that is, I think, a great opportunity to see, in terms of building a portfolio. We think there's great opportunities in finding, avoiding stocks that are hyped on their direct exposure to AI, to finding the ones that are yet to be discovered because they're actually winners from bringing this technology into their business. We've seen this before as technology matures and it comes through cycles. If you go back to 2000, it seems like ancient history, but this is that was the period when markets were very concentrated, and one of those very large stocks in the benchmark was a company called Cisco. Cisco has been forgotten, but it was the pick and shovel business of the Internet 1.0. It sold the networking equipment that built out the internet. It grew rapidly, and that growth was extrapolated at the peak of that euphoria in a very risky manner. Now, this company has really entered into that, what we call the quality growth purgatory bucket, where investors have forgotten about it. It was one of the 4 horsemen of the internet. The other 3 were Dell, Intel, and Microsoft. Now, out of those 4, really, it's only been the application company that has remained relevant. So we'd be very cautious around the euphoria that's being applied to the semiconductor stocks that are seen as the pick and shovel companies of the AI. It's time to look broader, and Capital One, I think, is a great example of being, looking forward at a business that's really well positioned. It is the largest digital bank in the US. It's post the merger with Discover, it will become the biggest or the largest credit card issuer by card balances in the US. Now, importantly, Capital One made a very hard decision 6 years ago to rebuild their entire tech stack in Amazon AWS, in the cloud. Now, we think that just gives them a very unique advantage today against most other banks in the US. Quite frankly, it's differentiated globally as one of the few companies that has its tech stack in the cloud. So as they deploy AI tools, they should be able to drive down customer acquisition cost, and they should be able to manage credit cost much better than their competitors, so they keep the advantage. What are you paying for that company? You pay a very modest PE of 7 times. JP Morgan is on 12 times. It has a similar ROE as JP Morgan. And look, we won't even mention CBA. So there's a great opportunity here. Thinking about companies that can benefit from this regional, also from a broadening in AI deployment, but also a broadening in markets in a regional sense. China, as we know, has gone through a down cycle in growth. Some of it's structural, but some of it's also cyclical, i.e. the resizing of the property sector. We think we're through that and we're coming out the other side. JD.com is very interesting in the sense that they've concentrated their efforts in e-commerce in the white goods segment and the electronics segments. So they are a 40% market share business in those segments, and that represents half of their business. Now, why is that important? It's important because that's where the Chinese government is stimulating. And quite frankly, if you think tariffs are going to be much worse on China, you'll pick up the benefit of that. And I say benefit because we believe the stimulus that the government's putting in to the segments, if you think about what tariffs will hit, they'll hit the manufacturers of white goods, they'll hit the manufacturers of electronics, and the Chinese government will seek to replace external demand with domestic demand, and JD services that domestic demand. So they will be a net winner from higher tariffs. Now, that stock is available to you on a very modest PE, 8 times. We think the business is growing over 10% per annum, and the company is doing all the right things for shareholders in terms of buying back stock. Very quickly over the entire portfolio and how we're positioning the Global Value Fund. Yes, we are underweight the US. Now, when we look at that on a domicile basis, when we switch to a revenue basis, it's a lot less than you think. Because most of what we own in Europe is multinational. We don't own Europe because we think all of a sudden Europe is going to rediscover or discover American capitalism. We own it because you've got high quality multinationals that give you global exposure. And on that basis, we're only 10% underweight the US. Where we do pick up some domestic exposure to Europe is in our financials. And yes, they will benefit from looser fiscal policy, which we think is coming in Europe. We're overweight EM, and we're overweight EM in very high quality companies. In fact, the Magnificent Seven of China are trading on roughly 1/3 of the multiple of the equivalent stocks in the US. Now, no AI hype in sight. Well, maybe just recently because of DeepSeek. At a sector level, we're overweight commodities and industrials. We want to capture that broadening out from a manufacturing cycle rebound. But we are underweight hardware because we believe that the mega cap hardware space is becoming, the discount rate is going to increase as the range of outcomes around AI and who in fact is the winner is going to broaden out. And then we have our defensive tilt through pharmaceutical, through Ventas, which is an aged care REIT in the US, and gold stocks, where we have a very active position. As you know, gold is in a stealth bull market. I say stealth because it doesn't get any of the headlines that Bitcoin gets, and it's been an amazing asset. It's outperforming most assets today, And yet gold stocks trade at almost record discounts to their NAVs. Gold stocks used to trade at premiums to their NAVs, and now we're in a bull market and they're trading at discounts. We see that as a relatively fat pitch. Pragmatic value is really seeking those mispriced opportunities relative to underlying business resilience and growth. And we're really taking advantage of cyclical, structural, and macroeconomic change in markets. And in our view, pragmatic value never goes out of style. Thank you.